is that Lamb did a study of silver mining stocks during the 1950s and 60s. And in the United States, there used to be something called the Spokane Stock Exchange. And he found that the average one went 100 to 1 from the lows in 1960 to the highs in 1968. And the best of them was a company called Coeur d'Alene Mines, which went 1,000 for one, from 2 cents to $20. This market is crazy, but it's going higher.
For most investors, the focus remains fixed on price charts, gold at new highs, silver breaking out of multi-year ranges, and headlines celebrating nominal gains. But history shows that the greatest wealth creation in precious metals cycles has rarely occurred in the metals themselves. It has occurred in the companies that extract them, particularly during periods when the broader financial system is quietly destabilizing beneath the surface. This is the exact case Doug Casey makes in his latest analysis. Casey is not looking at short-term price action. He is studying where capital historically migrates when confidence in money begins to fracture. Casey argues that silver miners represent one of the most asymmetrical opportunities in today's market. While silver itself is already drawing attention for its strength, the equities tied to its production remain almost completely ignored by institutions and the general public. That divergence matters. Historically, when precious metals move first and miners lag, it is not a sign of weakness. It is a sign that the most explosive phase has not yet begun. When capital finally rotates, it does not do so gently. It rushes. The historical record supports this view. During previous monetary crises, particularly in the silver bull market that culminated in 1980, silver mining stocks produced extraordinary returns from deeply depressed levels. Casey frequently references earlier cycles as well, including the 1950s and 1960s, when numerous silver miners delivered gains of 100 to 1 and in exceptional cases 1,000 to 1 from their lows. But because monetary stress forced investors to seek assets anchored in physical reality. In this video, we'll break down Casey's reasoning, the extraordinary opportunity he sees in silver miners, and why he believes this cycle may ultimately reshape the entire monetary landscape. If you value deep, long-form market analysis like this, support the channel by liking the video, subscribing, and sharing your thoughts in the comments below. We appreciate the support and hope you enjoy the video.
There are two areas that I'm very interested in today. One is the monetary metals and commodities in general, which means gold and silver. And the other thing is the energy commodities, which is oil, natural gas, and uranium. And right now, oil, natural gas, and uranium are the real bargains. In fact, of all the commodities, they're the cheapest ones, along with the grains, soybeans, wheat, and corn. Gold and silver, as you know, have exploded to new highs. And I find it very interesting that the worldwide media doesn't seem to be paying any attention to this. I think we're on the edge of a massive monetary and economic crisis. And gold and silver are leading indicators of something very unpleasant that's about to happen in the world economy. So, as you know, I've been long gold and silver for many, many, many years, and I remain long them. The higher they get, of course, the higher they get, I mean, the potential leaves them as they go higher. But the best rule of investing in these situations is be right and sit tight. And I don't know how much higher they can go in comparison to everything else in the world. Houses, cars, clothing, meals and restaurants. Gold is now overpriced, so is silver. They're both overpriced by historical norms. But there's something different and special going on with the world monetary system. So I think they can go higher. And the end phenomenon of it is going to be that currencies will be backed by gold. And the question is, at what dollar number is that possible to do? And in the case of the US dollar, it's hard to say because they don't even know how many US dollars are in existence. M1, M2, count dollars outside of the US, they don't really even know. But is it possible that it goes to $25,000 an ounce? Yeah, it's possible. Gold and silver are both monetary metals throughout history. But today, they're very different from a monetary point of view. All the gold that's ever been mined basically still exists someplace in a vault or above ground. That's not true of silver. Silver is primarily an industrial metal. You know, before the mid 60s, the US government alone owned 2 billion ounces of silver. It's all gone. And for the last 3, 4, over 5 years, silver has been in deficit. In other words, industrial uses have been more than have been mined. So the world is living on silver inventories, and they're getting low. So it's unlike gold. It's you've got to analyze them in a different way. But having said that, they're both high-tech metals. People forget that silver, of all the 92 naturally occurring elements, is the most conductive of heat and the most conductive of electricity, also the most reflective of light. So that makes it a natural high-tech metal. And that's also true of gold, not quite to the degree of silver, but gold is the most non-corrosive of all metals. So they both have a lot of use other than as money, which is good.
Definitely. Doug, why do you believe big money hasn't fully piled into undervalued silver miners yet, even with the silver all-time highs? What historical precedents suggest what happens when institutional investors finally wake up?
Well, first of all, it's a tiny little market, so that the really big players can't invest in it because the value of these silver stocks is way too small for people that are managing tens and hundreds of billions of dollars. It's not even a rounding error. That's one reason. Another reason is because uh, conventional money managers, just like conventional economists, don't believe in the metals as money. Uh, they've been propagandized for many years with Keynesian theories. They believe that paper can be money, that credit can be money. And so it runs counter to everything they've learned and everything that governments are built on. That's the second reason. The third reason, when you're talking about the miners, is people hate miners because of the green movement. They've been taught that miners rape Mother Earth. It's a dirty business, and young people don't want to play around and digging in the dirt with big yellow machines. So, for all these reasons, there's no interest on the part of either institutions or the general public in gold or silver miners right now. Now, they've done pretty darned well in the last year. Most of them are up 200, 300%. But compared to what they've done in the past, and especially with the metals being as expensive as they are today, I think they're going to go much higher. And although I own a lot of gold and silver, the real action is in the companies that mine them today.
Casey's central argument begins with a distinction that most market participants fail to make. Gold and silver may both be monetary metals, but structurally they are nothing alike. Nearly all the gold ever mined still exists above ground, stored in vaults, central bank reserves, or private holdings. Silver does not share that characteristic. For decades, it has been consumed by industry, electronics, solar technology, medical applications, and advanced manufacturing, and much of it is gone permanently. This is why persistent silver deficits matter. When annual industrial demand exceeds mine supply year after year, the market is not balancing itself, it is depleting inventories. That imbalance creates conditions where price discovery can become violent. Silver does not rise slowly when shortages emerge. It tends to gap higher once available supply tightens. Casey emphasizes that this structural pressure exists regardless of investment demand. Even without speculative participation, silver is being consumed faster than it is produced. When investment capital eventually joins that dynamic, the price reaction is rarely linear. This is one reason he views silver miners as uniquely positioned, because they sit at the intersection of constrained supply and a metal that historically responds explosively during monetary stress.
Look, I've always said in the past, when will I know that the gold market has peaked? And the answer, I always answered that question by saying when Time or Newsweek magazines, if they still exist, have a picture of a golden bear tearing apart the New York Stock Exchange. And that would be a signal that gold is peaking and it's time to buy the New York Stock Exchange. We're a long way from that yet. And the same is true of silver because most institutional investors don't even care about silver. It's not even on their radar screens. It's a non-entity. It's meaningless to them because all these silver mining stocks, and there aren't that many of them, uh, are too small for them to invest. They don't care. They don't look at them. The public is not involved in them. Look, there was a book written, when was it written? It was written in about 1970 by a guy named Norman Lamb, and it's called Small Fortunes in Penny Gold Stocks. And the reason that book is interesting is that Lamb did a study of silver mining stocks during the 1950s and 60s. And in the United States, there used to be something called the Spokane Stock Exchange. It doesn't exist anymore. I visited it. I mean, I've actually been there when it existed. Anyway, in Lamb's book, which I'm sure you can find on Amazon, he tracked these numerous small silver stocks, which existed then in Idaho, in the Coeur d'Alene area. Most of them don't exist anymore. They're not traded anymore. And he found that the average one went 100 to 1 from the lows in 1960 to the highs in 1968. And the best of them was a company called Coeur d'Alene Mines, which went 1,000 for one, from 2 cents to $20. So even then, they were volatile. But there's a lot more money in the world now than there was then. And people cared more about silver back then than they do now. So yeah, this market is crazy, but it's going higher.
How do you recognize the blow-off top? Are miners still a good purchase at these levels, and what does he do to hedge his positions?
The blow off top will be when, of course, they don't have magazines so much anymore, but 10 years ago, certainly 20 years ago, you could just go to any drugstore and look at the magazines, news magazines, and see what was on the front cover. So when everybody is talking about gold and silver and it's on the cover of internet magazines or blogs or whatever, that's a sign of a top, but nobody cares about it. Nobody knows that they exist, so they can go higher. The public is not involved in gold and silver, and absolutely not in gold and silver stocks, and the institutions aren't involved. So they don't own much to buy, and I think look, they don't have anything to sell, and they're going to be finally be buying. There'll be a mania in gold and silver stocks. We're nowhere near that today. So let's
Yeah,
ask me that question in a year or 2 years.
it
And I
will
hope we have.
resonate. Yeah. Second question, what would have to change in the world for Doug to even start to consider selling silver and gold?
I'd like to see stability in the world. But now, since we may be on the edge of World War III, I mean, it's very hard to predict. But this conflict between Russia and the Ukraine, it hasn't ended. And there's lots of other conflicts in the world that could pop up anytime. And you want to have money, physical money, in your own hands, your own possession. Few people have that. All they have is paper credits, currencies of bankrupt governments. So I guess I'd be willing to sell my gold and silver, but wait a minute. I can't sell money, which is what they are. I can trade them for other things. So maybe at some point the real estate market will crash or the stock market, regular stock market will crash. Okay, then I'll liquidate my savings in physical gold and silver and buy other things. But we're nowhere near that time today. The stock market in general is very expensive, and so is the real estate market. Worse, the real estate market floats on a sea of debt. So, and the whole world is unstable today, very unstable. No, I'm not selling yet.
One of Casey's most important observations is how market tops actually form. They do not occur when prices reach new highs. They occur when participation becomes universal, when the public is emotionally involved and institutions are already fully positioned. In precious metals, that moment is marked by media obsession, mainstream enthusiasm, and widespread belief that prices can only go higher. By that standard, this cycle is nowhere near exhaustion. Gold and silver may be strong, but they remain largely ignored outside specialized investment circles. The same is even more true for silver miners. Despite meaningful gains over the past year, the sector remains underowned, underfollowed, and widely misunderstood. Historically, this has been the precise phase where the groundwork for exponential returns is laid. Casey's reference to earlier silver bull markets is not nostalgia. It is a reminder that monetary crises tend to produce similar behavioral patterns, even if the catalysts differ. When confidence in paper assets erodes, capital eventually seeks tangible scarcity, and mining equities become a vehicle for that migration. Perhaps most unsettling is Casey's broader warning about the monetary system itself. Gold and silver do not react emotionally. They respond to pressure. When they begin moving decisively, it suggests that something beneath the surface is failing, something that may not be fully visible until the damage is irreversible. The widening cracks in global debt, currency debasement, and geopolitical instability are not isolated developments. They are part of a system under strain, and the metals appear to be pricing that reality in advance. For investors paying attention, this moment may not be about chasing price. It may be about positioning before recognition arrives. Casey's message is clear. The real mania in precious metals has not begun, and when it does, silver miners are likely to outperform the metals themselves by a wide margin. As always, patience matters more than prediction. Being early is uncomfortable, but being late is expensive. Thank you for watching, and if you found this analysis valuable, please like the video, subscribe to the channel, share it with others who follow macro markets closely, and leave your thoughts in the comments below. Your support helps keep this kind of long-form, serious market discussion alive.